Hi, this is Dustin with Dustin's Dollars. Today I'm going to be talking about Knightscope and the impact of inflation on Knightscope and their potential pricing power that they have. Before I begin, let me remind you that I am not a financial advisor or a financial professional of any sort. All opinions that I express in this video are mine and do not represent those of any company or any other individual. I currently hold a long position in Knightscope. So basically this video should be for your entertainment purposes only, because I could be wrong about everything I say in this video. You need to do your own research before making any investment decisions. That being said, let me get into it today. So inflation is real. It is here. I am taking two data points here from the most recent numbers that I could get from the government. We have the producer price index, which is gives you an indication of prices at the producer level, right? And this I'm using as a good proxy for what Knightscope could be seeing for the prices that they're paying for their materials, right? That they're purchasing from producers. And the most recent numbers that came out from in February, I think we'll have the March numbers released soon in April. I think they lag by a month in being reported. The producer price index was up by 10% for the 12 months ended in February. So 10% inflation in their prices. And if we look at the employment wage growth, I'm going to look at a couple different numbers here. They say that average hourly earnings over the past 12 months, and sorry, this was reported for March, the average hourly earnings have increased by 5.6% over the past 12 months. But I like to look a little bit more in detail, right? Because that doesn't quite tell the whole picture, where this is a supplemental table that they also released that has the average hourly earnings, and it breaks it out by industry. And so this left column here is the March 2021 average wage in that industry, and this then they have January, February, and March for 2022 for the average hourly earnings in each of these months. And I like to go down here, and when I'm thinking about Knightscope, and really I'm looking here for some sort of a metric to tell me what is the increase in the labor rate for security guards, because that is roughly right now what Knightscope is compared against in terms of their costs that they charge, right? What they take in as revenue, what they're charging their clients. And so this is obviously not broken out to that level of granularity where I can say what was the rate increase for security guards. Maybe there's a better place on the internet to gather that data. I don't know. I'm not sure that I could get it from a year ago, though. But if I look at this, I'm looking at sort of lower paid jobs here. I look at retail, where over the past 12 months, it went from $21.50 to $22.89, giving an inflation rate of 22.89 divided by 21.5 of 6.5%. And then I also look down here at leisure and hospitality. That's another low end job. It's right here down below my calculator. And so that one would be 19.68. Now it used to be 17.6 a year ago. And that one is a massive, almost 12% increase in the average hourly rate there. And I'm looking at those rather than some of these higher paid jobs, because I think those are more direct competitors for the same folks who would be working a security guard position, right? These are at least similar rates, right? When the rates that you do see quoted in, say, the Knightscope marketing materials and some other places, they're using hourly rates around $17 an hour. I think they use $17.50 in their investor presentation. So I just don't think it makes that much sense to be looking at some of these sectors where people are being paid $30 and $40 an hour. It just doesn't make sense as that data isn't really relevant. So anyways, I'm looking at that and saying, well, the labor rates for security guards are probably similar and have probably gone up somewhere between 6 and 12% over the past 12 months, which is pretty large. So that's sort of the backdrop. And now going into the meat of the presentation today, how do I think this actually impacts Knightscope? And they do actually call this out. The most obvious impact of inflation is what are they paying for all of their parts? What are they paying for their labor to assemble the robots, to service the robots, those sorts of things. And they do even call out just a tiny bit in their 10K, just wanted to mention here, that they have had cost inflation, it has impacted and could continue to negatively impact our ability to meet increased demand. And I think this, speaks to one of the things that they've historically said, that they were sort of, some of their growth has been hindered by being low on cash. And I don't think that that's been inflation over the history of the company, but it could have been more recently in some of the 2021, sort of that sales backlog that we saw in 2021. So that's really the only statement that they have in their SEC filed materials that I could find. But going on to how I'm thinking about this and how I'm modeling this, I go back to their unit economics on their. I'm going to first talk about their unit economics, the per robot, how those numbers work out. Then I'm going to extend that and talk about how this affects the company overall. And then I will move on to, sort of what I think about their potential revenue increases, because I think it makes sense to look at it logically in that order. So if we just look at the unit economics, hopefully you've seen this before. This is from the Knightscope investor presentation. And I know I've certainly covered this on my channel before. But just as a quick refresher, if you haven't seen before, they pay about 54. Let me see if I can zoom that in just a tiny bit and scroll over to the salient bits. So they charge the customer about $60,000 per year. In the first year, they add on another roughly $10,000 in the form of some sort of a deployment fee, I guess. And so these green bars here are showing you the revenue that they are taking in, the Knightscope is taking in from their client. This is a modeling on a client that renews renews and has the robot at their site for 5 years, which they have had some clients at least publicly stated that they've renewed it for that long. So this is the economics for that one robot being deployed and then operating for 5 years. So that's their revenue. Their costs are, they have this red, which is their initial cost to actually build the robot. And then you have these yellow bars here, which are their actual service costs. And you have, this is slightly larger in year 1 because they have to do the deployment. And then in years 2 through 5, they just have to service the robot and, fix repairs and maintenance, that sort of stuff. So what this shows you over time is their revenue and their costs in a very simple model, and their net cash they're collecting every year. So in year 1, they actually lose $5,100. In years 2 through 5, they would actually be making about $45,000 of net cash flow of profit. So that is the model that they provide. I copied that into a spreadsheet here, which I will zoom in so you can hopefully see. And I put in some multipliers here. So I have exactly their numbers. This right now matches what they had there. This row is their net cash flow in each year. Row 7 here is their cumulative net cash flow, right? That's how much money they've actually made from the time that they deployed the robot all the way until the end of this year, right? So after year 2, I'm saying they've actually had a net positive cash flow of $40,000, and then that just increases every year by that, $45K, until at the end of year 5, they have made $176,700 in profit. And, then I have just their margins as you would get that, so sort of based off of their cumulative net cash flow up into that year, right? And so the end of year 1, they are negative 7.3%. By the end of year 5, they have a 57% margin if you amortize all the costs over those 5 years. So what I also have here is multipliers for what do I think, I can plug in numbers for price increases, both for the clients, right, which would increase their revenue. And I apply this to both their lease revenue and their deployment fee. Then you also have, I also have a number here that I can put in for how much their costs go up to actually build the machines. And then I have a number here that we can put for how much the costs increase for all of their service calls for their initial deployment fees, or for what their costs, I should say, their costs for deploying the robot, and then their costs for repairing and maintaining the robot over the lifetime that it is deployed. So this is where we can start to see the impact of some of this stuff, right? So if we put in let's assume they don't raise prices for clients right now. And let's say that they, we saw that producer price index, let's say that their costs go up by 10% for their materials that they are acquiring. And you can see right off the bat, what does that do to their margins? Things get even uglier in year 1, and then by the end of year 5, but by the end of year 5, if a client actually does renew for that long, their overall margins go from 57% to 55%. So not a huge impact, and you can see that their net cash flow, and this is mostly because they only incur that machine build cost in year 1, right? We could even say that those costs go up 20%. You can see their final margins still only drop down to 53.5%, and that's really because the machine, they only have to pay that cost once, and in terms of their overall cost, it really is a not a huge amount. We also can look at the cost of their service calls, right? So let's say they have to pay more for, this is a mix of the parts they use for service and a mix of the labor for those service calls, the actual people who have to do the work. And so let's sort of use some mix here. Let's just call it 12%, right? Let's say their parts costs go up by 12%. Let's say that their labor costs also go up by 12% for those folks who are doing that work. And you can see what this does to their overall margins, right? And again, these numbers are, this is just a bit of a tangent. These numbers that were originally provided from the investor presentation, you have to at least start with the assumption that those numbers are close to credible. I will fully acknowledge we have not seen this in practice yet. I think we haven't seen the evidence of it. And again, I've covered this so many times. I'm not going to go into too much detail, but they just haven't really scaled. And so we really haven't been able to see what their economics truly look like. If they start to grow, we should see this a bit better. But if you look at this, you can see that, assuming that these numbers are in the ballpark of being credible, even increases in their costs, and let's even say it was 20% increase for the service costs, right? So every year, their net cash flow actually went down from $45,500 to $42,500, and so even with this model, they are profitable after year 2, right? They still lose money in year 1. In fact, they lose more money in year 1, obviously, because their costs go up and their revenue didn't in this hypothetical I'm looking at. But their margins are positive, right? They do actually make money by the end of year 2, and then years 3, 4, and 5 just are even. You continue with those net cash flows that are very high margin at that point. Now, they don't exist in a vacuum, right? They could raise prices for their services to the clients, and I'll talk about this in a little bit more detail later. But if we just are just looking at their unit economics, let's just ask the question: what would it take for them to increase their what percent increase would they have to have in their price in order to, let's say, get back to that 57% margins at the end of year 5 that they had before we factored in, let's say, 20% increases in their machine build costs and their service costs. And I'm going to try to do this sort of in real time and just iterate, because I don't think, is it 20%? Am I being dumb? It's 20%. Of course it's 20%, because this is scaling everything up by 20%. Thank you. Obvious. But I think you can look at this. Let's say they don't even raise their prices quite as much. They're still getting good margins, right? And like I said, even if they don't raise their prices at all, using those base numbers as a starting point, they still have 48.5% margins. And I think they, there's going to be a balance here. And this is at least to say that they don't have to increase their prices in lockstep with their costs in order to be profitable, right? Their margins are not that thin. They have some leeway for those to decouple, so to speak. Now, let's move on and look just a bit about the overall company's economics, right? And this is relevant to keep in mind because their unit economics, is on a per machine basis, but in the scheme of their overall company, as of right now, the number of machines that they have deployed does not actually dominate their finances, right? The dominant factor in their finances right now is their operating expenses. And why did I use that number? I picked the wrong number that I wanted to use here. Let me open up real quick. Sorry, that sales and marketing number is not what I want. I'm just going to plug in 1 million here. That's my bad. I copy pasted it from their actual numbers. I'll mention this real quick. Sorry. If you look at their sales and marketing number, it was very high from last quarter. It has been historically. This is my speculation. Again, don't know for sure. Is that there's a bit in the filings, but my speculation is going forward, it will not be nearly as high. It will be drastically lower because they spent a lot of that on advertising. That was largely due to fundraising. So that's why I'm putting in 1 million here rather than the 4 million or whatever that it actually was in Q4. So I have their Q4 numbers here, other than that one, which I adjusted here. Let me even make that bold, underlined. I don't know, maybe just underlined. I'll leave it. That you see their OPEX was $4 million, right? And their actual revenue was less than $1 million. Their cost of revenue was, 1.6. And again, I've covered the fact that their cost of revenue is higher than the revenue elsewhere. Not going to rehash that in this particular video, but the point is, I put in a value here for inflation impact. And what we'll see here is that changes in those unit economics don't actually materially make a difference for the company right now. And so again, let's say they have 20% increase in their inflation impact, and quarter by quarter that would make things roughly $300,000. That would increase their loss by $300,000 per quarter, which when they're already losing $5 million per quarter is not material, right? They're already burning cash. Inflation increasing the cost of their robots is not going to, obviously I don't want them to spend an extra $300,000 per quarter, but it's not going to make or break things. And then I have another model here, which is parameterized also by the number of robots, so that we could project forward. Let's say, hypothetically, they had, I'm using 95 right now, and that even changes the numbers a bit. So my assumption here is they make $15,000 per quarter per robot deployed, and that their cost of revenue was exactly what it was in Q4 plus $7,500 plus 50% cost of revenue per my revenue model. So $7,500 per robot additional over that 80 robots that I assume they had deployed in Q4. So that's my model here, and you can see if I increase this and say, well, I actually think they're at about probably 95 robots deployed right at this moment, near the end or at the end of Q1, let's say. And if they grow, let's say they double next year and they have 190 robots deployed, and they are actually, per my model, turning a profit at the gross level, right? Gross profit is positive and not a gross loss. So I should say the gross profit. Yeah. This is, again, is assuming no inflation, but let's look at what the impact of inflation would be, right? So if they do get, let's say, 20% inflation, that would turn that actually into a gross loss. And this starts to be material. If they had 20% inflation, if they had double the robots deployed, this is, their loss actually turns, this is an increase of more than 10% in their loss from operations. And you can see that as the company gets larger and larger, right? Let's say, hypothetically, they double again the year afterwards, and they're at, 380 robots. A 20% impact, increase in the cost of revenue with no, excuse me, with no increase in their revenue, in what they're charging clients, would really start to impact things, right? That would be a difference of $800,000, which at that point makes a difference between almost increases their loss by, I'm going to say 30%, 40%. It's pretty big at that point. Now this gets me to the another point that I wanted to talk about. Sorry, let me fix my Zoom here so I can read my own notes. And that is their pricing power, right? And I think this is a big unknown. What we don't know is, I don't think that they've tried to raise their prices ever before. So we don't know how elastic their demand is, right? We don't know if they do raise prices, how many clients are going to cancel. We don't know how many sales that they would fail to now achieve if they were trying to sell at a higher price point. I think there's with their commercial clients, this might be a big deal. They've certainly made their intent clear that they do want to sell to the federal government. I think once they get to that point, you might see that it's easier for them to raise prices, whereas the federal government might not be quite as sensitive to price increases. But I think right now there's clearly and just to throw that out there, like inflation itself, right? If everyone is seeing 20% increase in their cost of revenue, it might not, or let's make this less pessimistic. Let's say 12%. We can see what the impact is there. But if the cost of the security guards is also going up by 12%, they may be able to raise their revenue, raise what they're charging clients, and increase their revenue by 12% without batting an eye, right? And that that could be actually a positive for the company if they do that overall. To raise both of those, because that would actually increase that spread relative to their operating expenses, and that scales more and more as they deploy more robots, and that starts to dominate their finances more than their operating expenses. And there's a clear ceiling right now. At least I think. Sorry, I shouldn't say there's clear, because I'm not really in the industry, but I think there's a ceiling on what they can charge per robot, and that is, when you start to actually approach the cost of a human security guard. Right now, I'm not sure there's anyone out there who would decide to pay for the robot versus a human security guard, right? I think there's just a general assumption that that a robot is not as good as a human security guard right now. I think, in the future, as the robot's capabilities really grow, they've stated their intent that they want the robots to be able to see and hear and even smell, and I would just throw onto their, sense in various ways, better than a human. I think they've thrown out some ridiculous numbers, like 100 times better than human, but excuse me. But if the robots actually increase their capabilities and clients start to see this in the future, they may be able to raise the prices to the point where they are actually charging more than what it costs for a human security guard, because the robots might be able to do more, right? That might fill more of a role. And, they're clearly not there yet. They clearly won't be there in a year or two. But I think if you look forward, if you're looking over a decade time span, there's the potential for that. And I think there's a major upside in the future where you could see the price increases actually matching price increases that Knightscope can push onto their clients, matching the increase in value that they can drive, because the robots themselves are, kind of a platform, right? They have software running, then they can ship a software update that could potentially improve the capabilities, and that delivers more value to the customers. And I think that's, that is part of my thesis for investing for the long term. And I actually, taking it back, looking at the company as a whole, I'm happy to see them hiring some of the folks that I see them hiring, machine learning experts. I saw some audio systems engineers, those sorts of things, where they're actually investing in the robots, making them better and better. And, all of those features, all of those improvements that they make they're going to be able to, deploy to, all their robots, and at least all the robots currently, if they're software updates, right? And maybe all the future robots in the next generation as they are deploying those in the future. But just that potential to really scale those new features across all these robots is, I'm very excited about that, right? And what that could potentially mean for their future pricing power. I think, so it's sort of in conclusion there for their pricing power. I think right now they have pretty reasonable pricing power, only up to the point that they are still a 30 or 40% discount to a human security guard, right? There has to at least be some savings for folks to, let's say, take a bit of a risk and purchase and buy a security robot rather than spending a chunk more and getting a human security guard. However, in the future, if that flips and they are able to deliver, a robot that will do better than your average security guard, human security guard, then you might see their pricing power really, really increase, and that could be huge for the company. So All right, let's see. Is there anything on the live chat? Sorry, I've been rambling for a while. Nope, nothing on there. I do these videos live. If you're ever interested, I do them around closely. Usually, it's been about 10 p.m. Eastern U.S. time. Feel free to hop on. I would love to have back and forth. Anybody wants to chat with me? I am open to all of that. Happy to chat about. Get some interesting, answer your questions, give my thoughts, get your thoughts. That's great. It's happened, on some of the streams, not always, but yeah. All right, so I will stop rambling. Thank you very much for watching, and